It's not a secret for me to say that Mohamed El-Erian is more diplomatic than I am. This morning, I'm saying he's coming out swinging. You judge for yourself. His words. Its credibility eroded. The central bank appears to have a choice between risking a recession or prolonging inflation. Mohamed goes on to say the Fed is increasingly being forced to consider those two things. Which policy mistake it wishes to be remembered for? Meeting its inflation target by causing a recession or allowing high and potentially destabilising inflation to persist well into 2023. I'm pleased to say Mohamed can speak for himself when he joins us now. Mohamed, do you think it's that binary, one or the other?
I do, and I'm really worried about it, John.
Why is that? Why do you think there's not an optimal soft landing outcome that Jim Bullard was talking about earlier this morning?
So look what's happening in the marketplace. The whole point of forward policy guidance by the Fed is to bring along the markets in an orderly fashion. Instead, we're seeing the markets run away further from the Fed and do so in a disorderly fashion. And that is why the risk of a policy mistake is so high. When you lose credibility, you start chasing the markets, but the markets run away from you even more. And that's the dynamic we saw yesterday when Chair Powell spoke. And it's only a week after the FOMC meeting. Remember, John, the FOMC meeting was last week. We're having this dynamic now, and we're seeing it again today.
You use that phrase disorderly, that word disorderly. Mohamed, what about what you're seeing across fixed income and equity markets is disorderly?
These are massive moves, John, that come on the back of comments from a Fed chair. Yesterday, we saw massive moves. Today, we're seeing massive moves. That's what's so disorderly.
Do you think we're effectively capturing now what you think this Fed's going to have to do this year?
No, I think that if the Fed ends up validating what the market is now sort of tempting it to do, the Fed will end up breaking something in the economy. But if the Fed doesn't validate what the market has done, the Fed will not reestablish its inflation credibility. That's the lose-lose outcome that you and I have been talking about and I've been worrying about since last summer.
Can we deal with should and will and get through both those issues? What do you think they should do and what do you think they will actually do?
So I never would want to be in this position, right? And that's why you heard me advocate for them to take their foot off the accelerator last year and not continue injecting liquidity into this economy until earlier this month. But now that you're in this position and you're going to end up making a mistake, which is the high probability outcome, I'd rather make a mistake of letting inflation persist than throw this economy into recession.
And what do you think they will do?
I don't know, John. They've been flip-flopping all over the place. They are now coming across as incredibly hawkish. A few weeks ago, they were coming across as incredibly dovish. So I don't really know where they are. It seems like a roller coaster right now.
Do you think that's the problem at the moment, Mohamed? As you point out, we experienced this with Chairman Powell in December. I remember that, the news conference. He said a certain range of things, and I heard them, and the market didn't trade on them. Then we got the minutes, basically said the same thing, and all of a sudden we traded on them. And a similar dynamic's played out in the last week. Hasn't really said much more than he said last week, yet as you point out, we've got these massive moves. Are you suggesting that the chairman and his words have lost credibility with some market participants?
So what I'm suggesting, John, will come as no surprise to you because I've been saying it for a while. They've lost credibility when it comes to inflation fighting. They've lost credibility in terms of their ability to forecast inflation, and they've lost control of their policy narrative. And that's why you're seeing this volatility in the marketplace every time we hear something from Chair Powell. They need to reestablish this. In the piece you mentioned, I go through how you do this, and it starts by being dead honest as to why you made such a big mistake, and explaining to people why you're better at forecasting inflation. I don't think that the marketplace believes that the Fed is better. Break-evens moved against the Fed when Chair Powell was saying that he's very serious about addressing inflation. That shows you the lack of credibility that the Fed is facing right now.
Mohamed, what's interesting about the forecast is not just the credibility around inflation that some people are questioning, it's also their ability to forecast unemployment. If you go through the summary of economic projections, and I know you have done many times over the last few days, you'll see that 3.5% number for unemployment for this year and again next year. And what I see in the essence of your piece, the cost of reclaiming credibility over inflation fighting is ultimately damage to this economy. Does it make sense to you? I've heard words like fanciful, fantasy land, this idea that they get rates anywhere near high as they want to, Mohamed, without damaging unemployment. Is that even possible?
So it is possible under what I call the immaculate solution. And the immaculate solution is that somehow the US economy benefits from a big productivity surge, from a surge in labor force participation, from continued financial market resilience, and somehow this combination immaculately occurs and allows the Fed to deliver on the forecast that you mentioned. But I don't believe that immaculate solutions happen every day, so I am concerned.
Where do you think neutral is, Mohamed? It's a phrase that gets thrown around a lot. Where do you think it is?
And I was fascinated by the discussion because people speak with confidence about neutral. There's two problems. One is that neutral has proven to be very variable. It's not a parameter, it's a variable. And the second is, how do you judge neutral, taking into account the fact that the economy and the market have been conditioned for years to live with very low interest rates? We don't know the dynamics of adjustment to higher interest rates. So, John, bottom line, I don't know where neutral is, and I doubt anybody actually can say with confidence where neutral is.
I'd make a further suggestion, Mohamed, that neutral for the economy might mean something very different when it comes to the market. I mean, when would it become a problem for the market? We're talking about interest rate hikes. Jim Bullard of the St. Louis Fed was on the program earlier this morning. I know you followed that interview with Mike McKee. He was talking about 3% on Fed funds by year end. We haven't even started to think about balance sheet reduction either. And Mohamed, I'm looking at the market right now, and we seem to be taking this in our stride, in equities at least. Why do you think that is?
So that doesn't surprise me. If you're an asset allocator and someone comes up with the proposal that you should reduce equity, you're going to say, well, where do I go? You're going to cash? Hell no. Inflation is at 7.9%, and I believe we may well touch 10%. You don't want to go there. That's a guaranteed negative real return. Do you go into bonds? Hell no. Bonds are adjusting. And it's a very painful place to be right now. Do you go into commodities? Do you go into Bitcoin? That's incredibly volatile. So you end up not reducing your allocation to equities, but actually looking to increase them. Now, that works as long as we stay in a relative space. And we have been operating in a relative space. That's why stocks have been relatively resilient, incredibly so, in fact. The one thing that you've got to be careful of is that we don't switch regimes into an absolute regime. At that point, stocks become more vulnerable. But it doesn't surprise me that stocks are resilient.
Can you build out a little bit more on what would constrain risk appetite, Mohamed? You talked about an absolute regime. Detail what you mean by that. And also, can you throw in the yield curve as well? Should that constrain risk appetite? We've heard from the chairman in the last day or so. He said it wouldn't constrain them necessarily. Do you think it could constrain risk appetite in the coming weeks? Would you be comfortable being long equities, given everything you've said? Given what's happening with this pocket of inversion emerging through the yield curve, 3s, 5s, 7s, above 10s?
John, look, if I'm investing over the next 12-month horizon, I would reduce equities at this point. I would take some money off the table. I think the market is giving you a wonderful opportunity to come out. And the reason why I do that is I don't think the market has factored in yet what's going to happen to the economy as all these changes start transmitting through the economy. So we are yet to see. My baseline, for what it's worth, is that we're going to see a global stagflation, lower growth, higher inflation. Within that, we're going to see depression in Russia and Ukraine. We're going to see a recession in Europe. We're going to see stagflation in the US. And we're going to see a number of commodity importing developing countries running into debt problems. That's the sort of world we're looking at, given the shocks we're taking. And the equity market hasn't quite priced that in yet, because it's still thinking in relative space.
Mohamed, you introduced the S word. What does that mean? What does that look like? You've used another phrase in the past, stagflationary winds. What does that all mean?
So first of all, the stagflationary winds have become much, much stronger because of what's happening in Ukraine and Russia. That is another stagflationary blow, and it is another great unequalizer. So we do have concerns for the most vulnerable members of our society and the most vulnerable countries. What does it mean? It means you'll see more and more downward revisions in global growth, more and more upward revisions in inflation, and policymakers are going to have less flexibility in responding. Increasingly, they're going to be forced into the choice that no one wants to make, which is which of the two do you target? We'd like to target both. We'd like to target high growth and low inflation, but the more stagflation takes hold, the harder it is to do that.
Mohamed, can we finish on something delicate? I said before the interview started that I'm more diplomatic than you are. That's true. We've been friends for a long time. You'd acknowledge the same thing. Say what you want to say now. If you had a question for Chairman Powell, what would it be? The chairman is still talking about last year as if it was somewhat of a surprise, even though people like you were warning about it quite a lot from the summer onwards, from about June time through the rest of the year. What would you ask him right now?
So I would ask him, isn't the first step of reestablishing policy credibility involve being open as to why the mistake was made, and what have we changed in order to make sure that that mistake is not repeated? Until we address this basic issue, the marketplace is going to worry about the same mistake being made over and over again, because that's what has happened in the last almost 12 months.
What did you make of it when the chairman said in the news conference last week, Mohamed, that this wasn't due to a framework shift, that he didn't want us to blame the framework shift for the reason they're in this position?
I was puzzled because I think there's broad agreement that the framework was well designed for a world of deficient aggregate demand, and we are living in a world of deficient aggregate supply. So I like that framework, but it's for a world that we no longer live in. So I was puzzled, and I don't think I was the only one.